Have you ever clicked buy, watched the chart move instantly, and still entered at a worse price than the one you saw? Have you ever placed a stop, felt safe for 2 seconds, then got filled far below it, like the market skipped the floor? That is liquidity. Price moves because somebody takes the available supply, and when the door is small, even a normal order can shove the market.
Most beginners think liquidity means volume. They open a chart, see big activity, and assume they can enter or exit cleanly. Real liquidity is how much size you can trade right now at a fair price without moving the market against yourself when pressure arrives. Liquidity is escape. It is the distance between the price you imagine and the price the market actually gives you when pressure arrives.
The first clue is the bid and the ask. The bid is what buyers are currently willing to pay. The ask is what sellers are currently willing to accept. The spread between them is the cost of immediacy. In liquid markets, the gap can be tiny. In thin markets, the gap becomes a tax your account feels the moment the order fills.
The number on the chart is not a promise. The last price is only where the previous transaction happened. It is a footprint, not a guarantee. A beginner sees the last traded price and thinks, I can buy there. A professional asks how many shares are offered and how fast they are disappearing.
That difference is why two traders can click at the same moment and get very different fills. A market order is the purest liquidity test. It says, fill me now at the best available prices, no matter what. If the book is thin, your order walks through multiple price levels and your average fill gets worse. That is slippage. Slippage is not only a broker problem, it is the market telling you that the visible price was smaller than your need for speed. A limit order says, I will trade only at my price or better. That gives you control, but removes certainty. Market orders buy certainty and pay with price. Limit orders protect price and pay with missed fills. Liquidity is the arena where that trade-off becomes real. Every click is a choice between speed, control, and probability. The order book is not a decorative panel. It is a queue. At each price level, there are orders waiting to be matched. When aggressive buyers hit the ask, they consume sellers. When aggressive sellers hit the bid, they consume buyers. If a level has almost nothing, price jumps to the next. That is why price sometimes moves smoothly, then suddenly teleports. Market depth is the cushion under price. Imagine dropping a weight onto foam. Thick foam absorbs the shock. Thin foam collapses. In trading, depth means how much buying or selling interest exists beyond the best bid and ask. A deep market can handle bigger orders without dramatic movement. A shallow market reacts violently to smaller orders. Volume can fool you. A stock can trade millions of shares in a day and still be dangerous at the exact moment you enter. Maybe the activity happened at the open. Maybe the spread widens in the afternoon. Maybe the book collapses on a headline. Volume says activity happened. Liquidity asks whether you can trade now, in your size, without paying a hidden penalty. The spread is not just math. It is emotion expressed in numbers. When market makers feel confident, they quote tighter prices. When uncertainty rises, they widen spreads, because being wrong becomes expensive. Spreads expand around earnings and sudden headlines. The market is not being unfair. It is repricing immediacy. The more urgent everyone becomes, the more expensive urgency gets. Sometimes the danger is not too much selling. Sometimes the danger is that buyers vanish entirely. This is a liquidity vacuum. Price drops not because every holder sells at once, but because the bids that should absorb selling are no longer there. That is why stops can fill badly. Your stop becomes a market order in the exact moment liquidity is weakest. News does not only change opinion, it changes liquidity.
Before a major report, many participants cancel resting orders. After the release, orders return only when people trust the new price range. That gap is where slippage lives. Inside that single candle, the order book can be burning, rebuilding, and burning again. A large fund cannot simply click buy on a massive position. If the order is too aggressive, it moves price against itself. So big players break orders into pieces, hide intent, and use algorithms to search for enough liquidity without revealing their full size. This is why liquidity attracts size. Big money does not only ask, where is the trend? It asks, where can I trade without becoming the trend? What you see is not always the full market. Some liquidity is displayed, some is hidden, appearing only when price reaches a level. Some is routed through dark pools or algorithms that do not show their full intention on the public book. The screen is an incomplete map. A good trader uses visible liquidity as evidence, not as a complete truth. Stops create liquidity because stop orders often turn into market orders. If many traders place stops below the same low, a break releases a cluster of sell orders. That gives aggressive buyers a place to buy from sellers, who are forced to exit. Price can pierce a level, trigger stops, and reverse. The chart was not hunting you personally. Your behavior was sitting in a crowd of identical decisions. A liquidity trap happens when the market invites late traders into an obvious move, then uses their urgency as fuel for the opposite side. A breakout above resistance looks clean. Retail traders chase. Stops sit below the breakout. If follow-through does not arrive, price slips back. Now the buyers who entered late are trapped, and their exits become selling pressure. Liquidity is where pain converts into movement. Thin markets make emotions louder. In a deep market, fear moves price a little because resting orders absorb it. In a thin market, the same fear creates a dramatic candle. That candle scares more traders, which creates more market orders. This feedback loop is why low liquidity environments feel irrational. They are not irrational. They are fragile. Before entering, ask, how wide is the spread compared to normal? Is there visible depth near the price, or does the book look empty? Is the market near a known catalyst? Is this the regular session or a thinner period? Is my position size reasonable for this instrument? Liquidity analysis is not prediction. It is preparation. It tells you whether the door is wide enough before you walk in. Adult trading is not asking, can this go up? Adult trading asks, if I am wrong, can I exit without damage becoming chaos? It asks, if the candle moves fast, will my order behave the way I expect? Am I using a market order because it is necessary or because I am impatient? Liquidity turns risk from a vague feeling into a practical question. Not just direction, execution. Not just entry, exit. Liquidity is the hidden environment behind every trade. It decides how tight the spread is and how real the displayed price is. If you understand liquidity, the market stops looking like random candles and starts looking like pressure moving through limited doors. Before your next trade, do not only ask where price might go, ask where the liquidity is and whether you can get out if the story changes.